In my last video, I showed you how property and business owners are writing off Escalades, Yukons, equipment, and property in year one, thanks to 100% bonus depreciation. It's a powerful tax tool, one that I've used myself, and I genuinely hope it's already working for you. But here's what I know from working as a business person for the past 15 years. Every great tax strategy has a chapter two. Chapter two of bonus depreciation is something that not enough people are talking about. So if you ever sell that Escalade, that Yukon, the equipment or the property, there's a very good chance that the IRS has a tax bill with your name on it. Today, I'm going to show you what that bill is and why it matters. The next video following this one, I'm going to give you some solutions and strategies that savvy investors are using to lower or even cancel out that bill. My name is Nichole Menzies, and I've been helping property and business owners make money or save money for over 15 years. Before we begin, I am a commercial real estate broker, not a tax professional, nor am I an attorney, so everything I'm sharing today is for educational purposes. Please take that information to your tax professional before you act on it. I want you to picture someone. Let's call her Lisa. Lisa did everything right. Watched my last video, talked to her CPA, bought an $85,000 Escalade, wrote the whole thing off in year one, and saved almost $30,000 in taxes. She felt like she cracked the code, and honestly, she did. 3 years later, however, she sells the Escalade for $40,000. Life is good. Then her CPA calls. Hey, Lisa, about that truck you sold. The IRS wants $14,800 from you. Wait, what? I did everything right, she said. And she did. But that is called depreciation recapture. It's a process where the IRS recovers a portion of the depreciation that they allowed you to write off. This is why I'm making this video today. Here's what's happening in plain English. When the IRS let you write off that truck in year one, they weren't giving you free money. They slid an envelope across your desk that basically said, keep this while you own the asset and grow your business. But then they whispered, but when you sell, we'll be back to settle up. That settling up is depreciation recapture. It's not a penalty. It's just the IRS collecting their deferred portion when you sell. But the write-off was worth taking, and I'll show you the math later. Now, here's what surprises most people. The IRS does not tax your truck the same as your property. You have two baskets. Basket one holds trucks, SUVs, equipment, and machinery. The IRS calls this Section 1245. When you sell any one of these things, the IRS looks at every dollar of depreciation you claim and taxes it like a paycheck. So your regular income rate applies. For many business owners, that's somewhere between 25% and 37%. Basket two, when you're selling real estate, when you're doing property renovations, the IRS calls this Section 1250. Same idea, but the IRS taxes back the depreciation you claimed. But there's a cap here. They can only do up to 25%. So no matter what tax bracket you're in, your building gets treated much better than your truck, and your truck gets taxed harder than your building. Let me show you what this looks like in real dollars. In the case of Lisa's Escalade, her Escalade fell under Section 1245. She wrote off $85,000 that year. Now, when she sold it 3 years later, she sold it for $40,000. So the IRS said that the $40,000 is taxable like a paycheck, and at a 37% tax bracket, that resulted in a $14,800 tax bill. But when she wrote off the Escalade, she saved almost $30,000 in taxes up front. That means that even paying this bill, she's still almost $15,000 ahead. Example two, business equipment. That falls under Section 1245. John wrote off $60,000 in equipment. Later, when he sold it for $20,000. At a 37% tax bracket, that tax bill is about $7,400. But John initially saved $21,000 in taxes when he first bought the equipment. So even paying the recapture bill of $7,400, he's still almost $14,000 ahead. Example 3. Joy purchased a property and was able to write off $150,000 in property improvements, which falls under Section 1250. She sold the building. Later, depreciation recapture at 25% gave her a $37,500 tax bill. But when Joy initially wrote off the improvements, she saved $52,500. So she's still over $15,000 ahead. Every single time, you'll still come out ahead, but you must plan for it now, not later, now. So now you know what depreciation recapture is and why it matters. The write-offs were worth taking. The savings are real, but you'll pay a portion back. And knowing that puts you miles ahead so you can plan your tax strategy ahead of time with your tax person. In my next video, as promised, I'm going to give you the solutions and strategies that savvy investors use to either lower or cancel this bill. So you really don't want to miss that. Hit like and subscribe so that you'll be notified when it drops. And until then, I'll see you next time.